on loop, Andy. Hang on.
Oh, we get it again.
One more time, Andy. One more time.
Well, it is a pretty addictive thing.
Let's see. Here we go.
The second time tonight.
Yes, it worked, Fenton.
Mate, I'm always a big fan of the double intro.
The double intro. We double pumped that one tonight, folks. We gave it one more whirl around the racetrack. Hey, good to see a bunch of you guys on. We haven't had a chance to hang out for a little while, but as we do, a few of the regulars on nice and early. Alison, good to see you. Rami, great to see you. Margaret, awesome to have you guys along. Hey, welcome to Wealth, Wine and Wisdom. Friday, September 17. Andy, what's on the wine list tonight, mate? I've got a bit of you can't really see it. It's called the elephant in the room. It's not a bad drop. Little
Perfect for this conversation, isn't it?
Yeah, I think it's very poignant, my friend. A nice little Pinot Noir. Nice and light and tasty. A few people have got their wines on and having a few little drinks. And there's questions already flying, so it's good. It's good to see.
Well, mate, I'm going to give a shout out to the boys just down the road at Fedris. Pinot Noir, beautiful. It's actually one of my favourites. About 2 minutes down the road, which is absolutely magnificent. So it might top up the glass with a little bit of that, and we'll
have a little look at what's going on. Well, Sean's going. It's time for the hard liquor. He's diving straight into it. The bourbon in the afternoon. So it's good work. So welcome everybody for a little afternoon glass of wine, a bit of a chat about things that are going on out there in the world of investing. For those who haven't been here before or you need reminding, Andy Fenton, Jason Whitten here, and we've been hanging out doing these Friday Wealth, Wine and Wisdom chats about our respective industries, bringing news, information, support, encouragement to our crew, our crowd, property investors, business owners, and investors alike. And ever since these strange and interesting times have been occurring, the COVID world, lockdowns and craziness around the world, Andy and I have been trying to make sure we bring a little bit of, I don't know what it is, maybe a bit of calmness to the situation, or maybe
a bit of uncommon sense.
A bit of uncommon sense. There you go. I like that. That's the way to roll, Andy. So welcome along, team. Great to have you guys here. We haven't been able to connect for a couple of weeks. Just things have been out of sync, but it's awesome to hang out with you today, mate. Catch up. We've missed all of you guys as we do, but a bit of clarity. That's it, Robbie. A bit of clarity. Hopefully that's part of what these conversations can do. And just so you guys know how it rolls today, or usually anytime we do a Wealth, Wine and Wisdom, we do a little bit of a sequence. We try to stay on track, don't we, Andy? We attempt to. But, usually we do a bit of like what's in the news. And there's been a fair bit in the news of late. Plenty of things on the up and the down, the round and round. So we'll talk about those a bit later, team. Often we like to see if there's something we can teach about things you should know. I've got something a bit later, Andy, you and I could sink our teeth into. I did mention it earlier in the week in one of my coffee chats, but I'd love your observations and feedback on it. And as always, team, if you've got any questions about the world of real estate, about the world of equities, shares, financial planning, finance, whack them in the chat. That's it, somewhere around there. And we will absolutely have a crack at answering those things a bit later on. So that's the general gist of it, team. And, what we like to do is have a nice glass of wine and just make sure we we keep the lips lubricated. Is that the right way to roll? That's not too. The throat not parched, and we can have a good conversation about this stuff that we're up to, Andy. So I thought I might kick it off this week. Usually you're taking the baton and running with it, but I thought I might give it a whirl. Absolutely. What's in the news?
Get into it.
Yeah.
Yeah.
Well, listen, Andy, over in my neck of the woods, we'll do a little bit of this, see if we can roll here. Again, what's in the news? Well, what's in the news, folks? We're breaking records all over the place. Home sales soar to a 17-year high. And what's going on out there, Andy? We're seeing the momentum of the marketplace, record low interest rates, record savings. Just of recent times, I chatted not so long ago, about a week ago, about Australians having the largest savings for many years as well, over 13 or 14 years, the highest savings rate, $200 billion banked in the last year, or tucked away. You and I both know that money in the bank account's not a great place for it, but at least it's better in someone's bank account for the moment, instead of out in consumption world. But for you and me, we love to see it moving and investing. Mm-hmm. But people are taking that cash and making upgrades and improvements and going for it with home sales. The highest volume, the highest number of property transactions, properties changing hands since 2004. And that's fantastic for Australian homeowners. Many people making some capital gains as well. And the government, Andy, they'll be having a bumper year with capital gains tax and stamp duties and all sorts of transactional stamp duties as well. And this is, folks, one of the things that the governments do hope that happen when this stuff occurs. The Australian government, they've only got a one or two trick pony. Let's stimulate the housing industry, and let's support mining. That's the kind of the two trick pony shot they have when it comes to economic stimulation. But seems to be working at the moment. I think that stuff will flow through. On the flip side, Andy, folks, what we are seeing, unfortunately, for a lot of people, is the listings. I just moved Andy out of the way, and I might just zoom in on this. Actually, I might just move you back. Hey, your head was in the way, Andy, but we'll see what we can do. Folks, just have a look at this one. You can see above Andy's scone. I'll try and zoom in a little bit. However, the number of transactions that's it. He's got the finger, and straight up there, the number of transactions, folks, being done in the marketplace are at a record high. And now we are, again, let me just check here. Oh, things are moving around as we speak, live on my document. We are now at, again, it says, since the beginning of the series, tracking the lowest. So then a record since tracking. I don't know if it's record all round. So we've got these two opposites, Andy. We've got lots of properties changing hands. However, the numbers of properties, the second-hand properties being listed for sale, is at an 11-year low, 26% aggregated down, and every city across Australia down in yearly change for listings. Down the prices go. No, they go up when supply goes down, folks. So out there in the news, this is what's happening in the world of real estate, team. And the pressures will continue in this space. Those listening in, folks, the pressures will continue. The interest rates are low, and I'll talk about those a little bit later on, potentially, Andy. But those are probably the two big headlines for me. What's been in the news, folks? in the last week or so when it's come to real estate. We've got these two ends of town. We've got these two weird views of the world where we've got record ups but record downs, and they are accelerating pricing. They're accelerating purchasing and values in the short term. Maybe the next 3 to 5 years we're going to have some momentum. Maybe a bit less, maybe 2 to 3 years, but we'll see how we go, folks. So I might circle around a bit later on, Andy, with one or two other things about things you should know. But I thought I might throw back to you and say, hey, what's in the news over in your neck of the woods, mate?
Well, mate, but before we jump into that, it's really interesting because you used a pretty significant date there. 2004 is an interesting period of time. I remember 2004. I was quite young at that point in time. I was doing a few interesting things.
Back in the day.
But look, I think the economy was probably growing by 2 to 3% at that point in time. That was the beginning of the big China consumption that sort of later on shielded us through the GFC.
Yes.
But very, very different point in time. Like it's an interesting point to take that statistic from, right? So the previous high was 2004, where we had, strong household consumption, reasonably, strong monetary policy. The cash rate, I think, was being raised throughout 2004, 2005. So almost the exact opposite of many of the major markers that you would look for in markets, or certainly in investment markets. So it might be really interesting to dovetail those together. But I know back then, strong economic growth, we don't have that at the moment.
Yes.
Rising interest rates, which we don't have at the moment. And extraordinary or exports that were really starting to gain momentum. So
that was the mining boom, Andy, wasn't it?
Yeah, it was the beginning, or it was starting to build up a bit of speed by then. I'd be interested to know. I reckon actually some of that might have been, the largely driven by WA back then. It'd be interesting to pull some of the statistics from back then, because it'd be very different reason for property to be growing at that point in time, or to property sales to be that high comparatively now as a
property growth and property prices. And it set a pace that hasn't been matched for my 22 years of observing in Western Australia. So,
right. Yeah. So that was that time where they started to go 30, 40% a year, and it just took off like a rocket, didn't it? It was unbelievable.
Went crazy. Yeah. And it's one thing too, Andy, and folks listening in right now, if you've got the answer, you might have heard me say this one before. I'll do a few shout outs to a couple of people who've joined us late. So DJ, good to see you, mate. Thanks for joining us. Alexis, bit late to the party and all out of wine. Oh, that's not a party at all. Oh, no. Quickly, everyone. Right. Alexis has got to run out and get some wine. We'll restart in 10 minutes, all right?
Uber Eats, come on.
Quick.
Get the thumb moving.
I'm pretty sure you could actually do Uber drinks somewhere. I don't know what it's called, but it's out there. Harry, good to see you, mate. And Jimmy, fantastic to see you. We've got a Facebook user. Sometimes, folks, Andy's in the corner there. You don't put baby in the corner. Never. There he is. But these lower listings should keep demand at a very nice, strong level. Absolutely. Yep. That's exactly what's going to happen, team. And unfortunately, very sadly, our supply chain, our new approvals for stock is low too. So, I've been sort of talking about these ones for a little while. Watch out, Andy. There he is. I've got to move this. And Harry's sort of saying, hey, what are possible factors that could impact property prices in a negative way in the future? I've got a few things to say about that as well, Harry. Maybe we'll circle around to that one a little bit later on. Andy, keep you on tender hooks there, Harry. Hang in for the answer to those ones, folks, as we roll along, because the 2004 land and that sort of 2004 to about 2008, 9, 10 even run in Western Australia, Andy, was supported. I've said this before, few of the team listening in, that was supported extremely by the not
Mind blown.
invention, but the launching of realestate.com. The eastern states,
Yes.
yeah, the eastern states discovered that they could sit at home and look at realestate.com and see a price differential that was insane on the western states, and money started to move around Australia in the real estate market like never before. So,
That's right.
yeah, it was an interesting acceleration. So, there you go, and that accelerated probably for that whole decade, that sort of 2000 decade, all the way to when the GFC imploded. The biggest global financial crisis the world had ever seen, folks, came tumbling down. There you go. So, all right. Well, what do you got in the news? What's over on your side of the equation, Andy, for what's in the news?
Mate, interesting you should say that, because you were in the news this morning. I tuned in for one of your Wealth Coffee chats and heard some very, very interesting stuff, which was great. I thought I'd just update you on some social commentary that you just completely went over your head.
I missed it.
There was
not enough coffees.
One of the viewers commented on your beautiful haircut, and you sort of bashfully said, "Oh, it's not looking too great today, but it takes me a little while to settle into my haircut." Jace, you dickhead. It was probably somebody who was in lockdown who hasn't had a haircut like me for about 7 or 8 weeks, and we're starting to look a little bit shabby. And when people come on and look like a rock star like yourself, we're kind of like, oh God, look at these people who are just. I think you even said, "Yep, just went down the street for a haircut today."
No social acuity. No.
So, ladies and gents, on Wealth Coffee Chat, Jace wasn't trying to rub salt into the wound. He was just blissfully aware the fact that you were trying to be ironical. So that was in the news. But mate, seeing as I'm throwing you under the bus at the moment, let's see if you can figure out this riddle. Oh, why am I up there? One might say I know how to figure this one out. But while I'm figuring out my IT to get myself back into view, what do you make of this? Australian workers, this is a riddle. Australian workers quit, unemployment falls.
Let me see. The number of engaged, is it engaged people looking for work? The number of jobs available? I don't know. I'm shooting blind.
It was, mate, you weren't too far. You weren't too far off. This one of my team, Alex, actually pointed this out today, and some interesting statistics that have been listed. And we've been talking a lot about inflation recently being a major marker that people need to be looking at and understanding, because the way that it's publicized is not necessarily the way that you need to be reading it. But the reserve banks of the world and the central banks and the federal reserves of the world are targeting employment. So I thought this will be an interesting one to bring up, just so that people don't blindly follow statistics that are launched out here. You can see here the unemployment rate actually decreased to 4.5%. Right, for this quarter, decreased to 4.5%. Now that's coming back off like 7, almost 12.
It was up there. Yeah, it was pretty big. Yeah.
Right. Now, but here's the thing, and there was that beautiful Wine and Wisdom that we did where we taught people how to lie with statistics, or at least we didn't teach them how to lie with statistics. We showed them what can be done with statistics. Have a look at this, though. The participation rate actually decreased by 65%. So is the unemployment rate low in Australia, or have people just plain out fucking stopped trying to find work while this whole pandemic stuff runs through? And the statistics at the moment actually are indicating that, well, ultimately people are just not looking for work. People have quit looking for work at the moment because of obviously the conditions that sit around it. And if you're in the New South Wales or Victoria, you have to have a jab, or you have to have 2 jabs in order to be able to do certain things. So this will be a really interesting one. I don't know where it's going to go, but I reckon it's a great one for everyone to be aware of, because this is the measure. The unemployment rate is ultimately one of the key measures that the government are going to use to raise interest rates at some point in time, or the Reserve Bank rather. And it's going to be one that they're going to start hanging their hat on to tell you how well they went. Because, Jace, you know what's coming just around the corner, around about March next year?
A budget?
A budget's going to be around, and there's going to be an election where we're going to get the chance to vote these dickheads back in or out, depending on what your view is, whether you think that they're a dickhead or you think you love them. We don't get too political here, but very much something that you should be looking for, because the next thing that's on the radar is obviously going to be wage growth, and that's the sign of a good, healthy economy.
Yeah,
So,
I was going to say that, Andy. Yeah. The real sign is wages growth, right? Because we've had flat wages growth for over 10 years.
Well, declining, in fact. I think I've got some of the statistics in here, because I was going to fall back based on this for some things that we'd spoken about previously. But yes, it's been steadily declining. So this is my red hot tip, and this is my crystal ball. Is come election time, they're going to be banding around incredibly low unemployment rates based off extraordinarily strong policy set by the Labor government in Victoria, set by the federal government around Australia, set by all of these people they're going to be jazzing it up. They're going to be going unemployment on the back of all this. See, everything that we did worked. If you want the true litmus test to figure out what's working, look for wage growth. Don't look for unemployment.
Wages growth. Yeah.
Look for wage growth.
Yeah.
So here's another one, Jace, that you and I saw coming, and I thought that we'd just pat ourselves on the back here, because about 2 months ago, you and I had a little bit of a conversation around believing. Let me ping my head over to the other side there.
Perfect.
You and I had a conversation, and we started saying we believe that it's going to be large institution push government rather than government push large institution. And we were talking about Sydney airports. We were talking about large pharma companies. We were talking about large tech, so on and so forth. So, mate, it's pretty clear. This one actually grabbed from Aviation Australia and had a look at the statistics here. But foreign airlines are at risk of leaving Australia ahead of international restart. The long and short of it, Jace, is the international airlines, some big names in here, are basically saying, listen, and they're targeting Aviation Australia, right? The association, and the association as then targeting the government.
Yeah.
The reason being is that that's just the way that it goes. You know,
that's lobbying. Yep.
But we're at real risk here in Australia for prices for international travel potentially going up, because policy in Australia has been soft. It's been extraordinarily soft until they lock you down, and then it's been extraordinarily tough. There's nothing in between. There's been no proactive policy. They've really shit the bed in many, many ways when you consider what's happening in the rest of the world. But, mate, this is the first sign, and I reckon we're going to see a lot more of this, large companies pushing in various different directions. So the first sign is the aviation industry, and you can bet that Sydney Airport stock price is going to be a little bit of a future gaze as to what's going to happen here in the short term, right? I think long term it'll be a very, very good bet, but it'll be an interesting one to watch as all this comes to fruition, because, Jace, you know, logistics of a small business is tough.
Yeah. You got to watch. It's an interesting one, isn't it, Andy? Because the idea that, if we lose that connectivity to the rest of the world, that could be, an extreme disadvantage to Australians, like economically, mobility wise, etc. There's some pretty important decisions to be made by governments and that sort of thing when it comes to, you can't lose that connectivity, because once it's gone, it's difficult to get it back. It's difficult to rein it in.
Absolutely.
Yeah.
And look, you and I, we don't always politician bash, but I'm going to today. They're pretty heavy on our industry, aren't they, Jace? When they feel like they can change the banking sector and adjust the property market so that younger people can buy property, so they then go in and attack the lending around Australia, they will just push legislation and disrupt an industry and cause complete chaos. But when it comes to proactive policy moving forward, Jace, there are companies that we're looking at the moment over in Canada and over in Europe, travel companies who have completely redesigned what the travel experience is going to look like. And the reason why they can do that is that there's some proactive policy by the governments which are going, this is what it's going to look like. This is what our long-term intentions are going to be, and this is what we're going to hit come hell or high water. We're going to get there, which gives businesses like yours, mine, and Joe, everybody's out there. It gives us a roadmap, a real roadmap, not these bullshit roadmaps that we're being taught about at the moment. It gives
Dead
us
ends
a real
and
roadmap.
fake roads. Yep.
Yeah, a roadmap to nowhere. Where did that? It's like, Jesus, these guys need Google Maps. I swear they need Google Maps. But this is a good thing in my eyes. This is a really good thing. There's going to be some significant pressure, and I reckon you're going to see a lot more of Alan Joyce in the media over the next few months. He was in the media probably for the wrong reason, being paid $1.9 million when every plane was grounded. But I think you're going to see a lot more of him to justify that $1.9 million salary price tag. And I think it is a good thing. And mate, while I'm having a swipe at people, I've had a swipe at politicians.
Keep yourself rolling, Andy. Keep yourself rolling.
Why don't I just have a bit of a swipe at the journalists out there as well, just because we love the sensationalist headings. This one's from the Fin Review, but I got sucked in by the heading. ASX fall, iron ore plummets to below US 110 a ton. And we had a conversation around this recently. Well, yes, of course it's going to bloody do that after our good old headline company BHP absolutely crushed it with a 64% EBIT, $19.4 billion in the bank, shareholder equity of 200 US billion for these numbers don't hang around for long. So like the headline should really read, a bit of price rationalization comes back into the iron ore market. Perhaps BHP won't be as profitable as they were last year when they absolutely crushed it.
Well, mate, I don't think that'd sell any newspapers, Andy.
But it would be true. I literally had I had 3 clients call me up and go, "Oh, what's going on with BHP?" And I said, "Yeah, they had a 64% EBIT last year." Oh, but I just read, and I'm like, "Yeah, look, they're going to go like this, but we don't sell every time we see a headline come up there. There's they've had an incredible run. You've got an incredible distribution." And there's probably going to be incredible times ahead. And I think that we were talking about it between my numbers are not coming to me. I think it's between 40 and 60 a ton is where the usual profitable business sits. So they're over double for a year or so. So, mate, that's what's been in the news for me. Other than, have we got time? Maybe just a quick one, mate. This one,
Harry,
I think
before you do that, mate, Harry wants to know what's with the disco lights. Are you going to go dancing? But we can answer that a bit later.
It's Harry, come in. So, mate, just trying to liven up the atmosphere. To tell you the truth, I couldn't figure out how to turn them off, Harry. So it's usually a static color, but we're having some technical issues over here at the moment in Fenton World. Technology is winning. Andy is losing at the moment. But mate, this is another interesting, and this is where I'm going to pull out the crystal ball again. And I'm going to call bullshit on some future headlines that are going to come out. And I'm calling bullshit on headlines that haven't come out yet, just to be clear. This one.
Hang on. Let me clarify. You're calling bullshit on something that hasn't happened yet. All right.
Correct.
Okay. Yeah.
Correct. 100%. Because I'm looking at this, mate, and I know there's an election coming. There's going to be a lot of disturbance as these larger companies put pressure on the borders opening. And unfortunately, mate, your mob in Queensland and our mob in WA and South Australia are probably going to suffer during the reopening period. That's one of my tips, unless the vax rates get up significantly higher, significantly quickly. And I'm not talking vax or anti-vax, like that's not, I would never talk about it in this forum. And what people do is none of my business, and vice versa. But what we're going to see, we're going to get forced down here. That's clear. But the reopening trade might hurt a little bit more for the states that haven't had the virus running around it. Because another headline was Gladys is actually entertaining the first 100 hotel quarantine, or the first international hotel quarantine adventure that's going to be starting soon. If it's running out of control, why not just take more people in? I actually think, personally, I think that's kind of commonsensical. It's like, well, if we've got it and we know we can't get rid of it, why are we bothering stopping more of it coming in? We've got to learn to live with it. And I know that there's a lot of complexities that sit either side of that. Don't want to get into that fight. But the one that I'm interested in forecasting for this year, US workers are now earning $15 an hour without much of a fight from any of the unions. So the graph down the bottom left, just above your head, Jace, is the percentage of workers in America earning less than $15 an hour. So it has been constantly coming down since 2018. There's been very, very little fight over there. This is actually what we've been talking about as a sign of a healthy economy, but I'm not sure that it is actually that sign. I think it's synthetic. And so what's actually happening is average wages are actually increasing. Some of the big leaders have been the large tech companies that have been pushing prices up. But here in Australia, I want us to be very, very aware of this, because this can't happen in Australia until the economy is healthy. And if this starts getting mandated and we all look to the US to see what's going on, to see what's happening, the reason why it's happening over in the US, I think, is partly because less people are looking for jobs. The other reason is large companies, are above that rate anyway.
Yeah, they set a different median, or they pull the median up. Yep,
correct, 100%. And this could be very, very anti-competitive for small to medium business in the US, and I don't want to be seeing the same thing in Australia. But my future prediction of the bullshit headlines that will come in the future is based on the roadmap of the US rising wage growth over in the US, adopting same policies and using a narrative that doesn't suit the story. I honestly believe, my cynical nature says that this is coming. I've been a little bit cynical today. I didn't intend to be, but well, that's the way the cookie crumbles.
There you go. Hot off the press, folks. Watch out for the bull. Maybe we should rename this segment, Andy, Bullshit Headlines. Bullshit headlines and lying statistics. The statistics lie. But it's true, though. It's so true, isn't it? At the end of the day, there's sensationalist media, and people react inappropriately. You and I have talked about this many times. With data and information. I had an investor today. What's in the bullshit? Harry's renamed it. Maybe we should have a competition. Why do we rename this segment? What's in the bullshit?
You've got to whack that up on the screen. That's gold. That's one of the best comments I've seen for a long time. The new segment name, What's in the Bullshit?
Sorting through the shit. There you go. Excuse those who are a little bit sensitive to the comical nature of our commentary. But yeah, I was chatting with someone earlier today about my property price. I checked it last month and it was up, and I've checked it this month and it's down. And I'm like, property prices are not the share market. The speed of commentary / tracking and data in places and spaces, it's just so inaccurate, in certain circumstances. So you've got to be careful for that, because you make a decision one way or another. Yep, Andy's feisty. I was fired up yesterday, Andy. I had a feisty day myself yesterday, but Andy's on the feisty today. So there you go.
I must have had a good sleep, and I've woken up and I've seen it for what it is.
He's seeing it clearly now. I can see clearly now what's gone? Something's gone. The rain is gone. Yeah.
I'd love to say that, mate, but we're about to get pounded down here, so that'd be slightly ironic, I think.
It's a sunny day here in paradise, my friend. But there you go. A few things. Maybe I'll sort of kick off with this one, and I'm sure you could add some value in this conversation. Things you should know, folks. Of recent times, we've seen, Andy, the banks make a couple of bucks, which is kind of nice. Nothing wrong with the banks making $1 or $2. You would think that would be okay. But let's see how we roll with this. But this is one of the conversations not so long ago. The big four banks posted pretty significant profits in September for, the certain quarters. Pretty good. Nothing wrong with banks being profitable. Folks, we all need our banks to be profitable.
100%.
That is for sure. We need AAA rating economically around the world. We need to attract foreign investment. We need to do all sorts of things when it comes to this stuff. But one thing, Andy, on the side here, and this one I sort of had a bit of a chat to everyone about the other day in one of my Wealth Coffee chats as we go. The interesting thing right now with property prices going up, record savings in Australia, record cash in banks, records everywhere. The lenders gave people some, funding holidays or mortgage holidays and so on. They came to the party. You and I said, I think, for the moment, we were quite supportive of those institutions doing their bit, but they weren't doing it for charity, Andy, were they?
No, I think they had their 1 week worth of gratitude from us, didn't they?
Yeah. I think we said it for 1 week. But check this out. Have a look at where they're getting their funding from. The cheapest funding they ever get is from who, Andy? Us as domestic deposits, people putting money in their savings accounts or putting money in a long-term account or, people's security, equity, securitized lending, the machinations of how lending goes on. It's complicated and deep, but team, a large overview of it, and Andy, correct me if I'm oversimplifying this, is, folks, when you pay principal back on your properties and you've got equity in your properties and you've got a 30-year term with the bank, or you've got a term deposit with the bank, they can take certain liberties with the assets that they actually control. You don't control your equity, your cash, and so on, and they are able to lend that out and make more money than they're giving you on those things. The laws of securitized lending. And for me, that's always an interesting one, because the banks have actually made significant profits, even though interest rates have gone down. I think it was like 62%. I did the math the other day. And Andy, how does that work? This is your speciality, spreads and swaps and all sorts of long-term, short-term, that sort of stuff. Can you enlighten us a little without getting lost in the weeds?
Well, there's probably a few different ways you could tackle this, and I'll talk to what's real, and then we can talk to what's a bit of a hypothesis. But effectively, what was happening before COVID hit is banks were getting hit with large amounts of capital based on irresponsible lending. That was that they came from the Royal Banking Inquiry and so on and so forth. So banks were already tightening up, and they were having to increase the amount of capital that they had. For every dollar that's lent, they need a certain amount of money stored for the liquidity. Meaning, if Jason comes and asks for all of his money back, that the bank can actually deliver on that.
Capital, what was it? Capital adequacy laws or something like that. Was that
Correct.
in that space? And
yep.
And I think, Andy, is it right to say, if we had a run on the banks or something, everyone wanted their savings back, that they had to have something to cover that, yeah?
Yep, 100%. Not to mention that they've got ridiculous amounts of anti-money laundering, our counter-terrorism measures that mean that if you go to take more than $10,000 out of the bank, you better get used to little rubber glove, because that's going somewhere in order to figure out whether you're doing the right thing or not. Because you cannot get large sums out of the bank, but you can certainly transfer them from one bank to another. And that's where a secondary market comes in, which is the 24-hour cash rate. And that's how banks manage their liquidity from one bank to another. They lend to each other on an overnight basis so that they can meet their liquidity requirements. And when they can't, they borrow in the overnight and then they settle out the next day. And so that's very, very short term. then when you so that's deposits, but then when you go into savings accounts, term deposits, and things like that, well, they have a little bit more time, and that means that they then can deploy that money into the market. And it's really quite simple. The reason why the banks made so much money, their wealth creation was decimated, right? Because effectively, and this is a brass tacks, Jace, the Royal Banking Commission was really came in and targeted the banks mostly because the banks were doing the bad behaviour. The banks, the AMPs of the world, the Commonwealths, they all said it. You can go and find it. It's on public record about the things that they had done wrong, and it was in wealth management. It was, charging dead people, all of these sorts of things. And then when the Royal Banking Inquiry, when the decisions came out and they adjusted the legislation, all of the banks left the industry. So all of a sudden, that heyday was over. And the banks were going, oh, how are we going to make our money again? And then COVID hit. All right. Now, for you conspiracy theorists out there, this is not the reason why COVID hit. All right. Because I know
hang on. I thought it was the politicians. No, it's the bankers. It's the bankers.
I know a few of you are about to make a very big leap, but that's not what I'm saying. Stay in the seats. Don't leap. This is not a conspiracy theory. But it is extraordinary. It's a great coincidence, and it's really served the banks, because what ended up happening is they increased their assets on hold, right? And then COVID started to come, and the government went, oh my God, we've got to give some relief to the banks to maintain payment stability. So immediately the Fed came to aid of the banks and basically lend money to the banks for basically zero. Very, very close to zero.
Long-term bonds, Andy, was it like
yeah, 0.1, 0.2, like 0.3s, and ridiculous. You could get 10 years worth of debt for 0.3%. It was incredibly low. And then the banks also tucked away more cash, because what did they think lenders were going to do when COVID hit? They thought everyone was going to go upside down.
Yeah.
And so what ended up happening was the banks were defensive. Like, they were so defensive as all of this hit. And then they've gone, hang on, all of these loans aren't going to default. All of these people are buying property. Hang on, boys, let's crack the whip. Let's start writing some loans. We're borrowing at 0.3, 0.4%. We're lending it back out at 2%. And then we've gone through a massive boom in domestic lending as well. And I'm trying to find the chart that I had, because I've got one that corresponds with this. And so they've been lending like no tomorrow. But part of the reason why they were so profitable is they were so defensive, and they were so prepared, not necessarily for COVID. Coincidentally, they were. And then they got more defensive. And then all of a sudden, bang, it was on like Donkey Kong. And there was signs of them reversing the responsible lending criteria. They didn't go out there and do it. They didn't need to do it.
They didn't need to do it, Andy. So that was the interesting thing. Those conversations. I was just trying to find you a chart here. We were waiting for it to be reversed and fixed up and whatever, and then technically it fixed itself up. At the end of the day, what's happened is
Well, while you're finding that, mate, this is the remember. I'll come back to it in a tick, but like 30 seconds. Remember when we were talking about what sort of a recovery is it going to be, Jay? So it's going to be a W-shaped recovery. It's going to be an F-shaped recovery. I don't know how the fuck.
Is it a U?
Got to start up there. They had the W. They had the L. They had virtually every letter of the alphabet.
Yeah.
And you know what? Every recovery's always been in history. It's always been pretty much the same.
It's a V recovery.
Mate, have a look at it. Look at it.
It's not difficult to see. Up, down, then up. All right. Yeah.
It's and some people might say, Andy, you're just lying with statistics, because perhaps you've taken a time sample that suits you. And I'll say, maybe I have.
Maybe.
But it is still a pretty definite V, even if there is a slight W, a slight L, a slight G, S, or whatever in there. There is a slight one. But supporting your argument, mate, this is the increase of liquidity that gets pumped via the banks into the market. And this is globally. So we've got, and this is in billions of US dollars,
Billions of
right?
dollars.
That's sitting over here in billions of US dollars. And when we call it assets, it's because when a bank lends money out to the market, that goes on the asset register for the bank.
Yeah.
That's part of their assets because somebody owes them money. So as you can see, I mean, it's almost universally exactly the same right across all of the major the countries, that everyone just went in hyperdrive here. And we know it, this is old news, right? But almost sort of doubling the amount. And if we go to the share screen here, mate, if you jump into the shared screen.
Yep. Turn that one on. Yep.
Check this one out. This is my new favorite little
See if you
geek
can zoom in a little bit, Andy, for us all.
There we go.
Can you pinch and zoom? Yeah. Perfect.
All right. So let's play a bit of a game here.
It's the ticker, Andy. It's the ticker.
Let's see. All right. What country in the world has a national debt of $703 billion and a gross domestic product of about 1.3 trillion? What country would that be?
Is that Australia? I reckon that sounds Australia-ish.
Right, it's Australia.
Hey!
Bang on the money. Absolutely. A population of 25.7 million. That's Australia. So while you're finding that,
you got to share the URL of that one.
This is absolutely incredible. If you ever got absolutely nothing to do with the rest of your life, come in here and watch this. It's guaranteed to go up.
Oh, crazy.
But these numbers are astounding. When you and I started Wealth, Wine and Wisdom, this 28 that's sitting here in the US was below 20, right? Was below 20. And we're talking trillions with a T, which we don't often do. But check this out, usdebtclock.org/world-debt-clock.html. Jason's going to share it in there.
Share that in the chat, folks. It's all there ready for you.
There's a great one that there's a link to the Australian debt clock. It's got a lot of great statistics in there as well that actually support what you were talking about, Jason. I might bring this back after you bring up your slide about debt as well.
Mate, yeah, don't terrify yourself, folks, all right? Don't get too freaked out about that one, Andy.
Well, it'll make your mortgage look pretty small. Let's just say that.
Yeah. Well, I mean, at the end of the day, it's about this income and money keeping moving in and around the marketplace, Andy. And you and I have talked about this one, truckloads of times. It's healthy for money to be moving into the economy, not just sitting in bank accounts, not just sitting in vaults somewhere. So, I think that's something that is pretty important for us all to sort of get our heads around as we go. But I've got a little one here, a little chart, might make a little bit of sense. We'll see how we go. Let me chuck it there. That's fantastic. Well, there we go. Oh, wait, I'll put my head up there. There we go. It's a bit small, but if we have a look at debt to income ratios, interest only loans, origination of loans over 90%. Some of these momentums are only just starting to take effect now in the lending market, Andy. And at the end of the day, it has taken a bit of time for these lenders to get back in the saddle when it comes to getting that money out there. We talked about those things for APRA changing. It hasn't changed as fast as we thought it was going to change. That's for sure. I would have thought 90% lending would have come back in vogue. It hasn't come back too heavily just yet, but we'll see how that works. I did see the other day, I didn't grab it, Andy, that NAB has launched a new business owner $2 million product. You and I have talked about this all the time. Business owners being second-class citizens when it comes to lending. Everyone else can get a 2% loan, but we have to pay 5%. That's just ludicrous.
Another one hot off the press.
Hot off.
$10 million business. I think is about 20 employees. Can't get a loan. Profitability off the charts. Had one negative profit year one year ago. Is about $3 million worth of profit or something to that effect. Can't get a loan for himself. Unbelievable.
It's a joke. It's ludicrous. Anyway, there you go. But maybe, Andy, maybe this is the thing that needed to happen for business, for lending. Like you've said for a long time, lending to be priced appropriately in the way for the risk and the risk of a business owner. The function of a business owner's life is not the same as someone who's got a job, and they shouldn't be judged / analyzed in the same way. That's the way I see it. Right now, the government many years ago, smartly for primary producers, gave primary producers a different tax sequence, tax cycle to behave in. I think it might have changed recently, or it might have changed, but is it a 7-year tax, a 5-year, isn't it? 5-year. You don't have to, tally the score for 5 years in primary production. That's simplifying it, folks. But, it should be the same in lending for business owners. Yes. Over the last 5 years, if you had one shitty year, well, you should be able to strike one out, or two out, or that should be adjusted for the pricing or the rate or whatever. Anyway, so hopefully that fixes up lending,
with it, mate. Because I reckon if these guys get 4 years a pop at trying to destroy a nation by ruling it, I reckon business owners should get 4 years to try and make a go of it before we get taxed.
You're dead right. Dead right. If it was up to me, I'd wave a magic wand and make it 10 years that you have to vote someone in. But anyway, I'm quite interested. I had a very positive experience when I spent many years in Singapore many years ago, and what I did learn at a very young age that you voted the government in for 10 years in Singapore, and now they're one of the only countries in the world that pay every citizen. Every citizen of Singapore receives money back every year from the money that's been invested by the government. So not only do you have I can't remember the actual dollars and cents now. Anyone who earns under 50 grand doesn't pay any tax at all. It's tax free in Singapore. But every citizen of Singapore earns about $7,000 or $8,000 back every year from the tax money that's been invested. So yeah, quite interesting. But that's that could be quite terrifying for a lot of people. That's for sure. Hey, Andy, why don't we circle around potentially and see if we can't give a couple of these questions that come up tonight a bit of a crack? And I think there was an early one. I don't know.
I'll just have another glass of the old Fedrus.
Yeah. Well, I mean,
down in my local area.
This one's for you, Andy.
Yep.
But Bob's a bit feisty tonight, so he said, "Hey, what do you think? What stocks should we buy if we go to war with China?" I don't know if we're going to go to war metaphorically in reality, but metaphorically, Andy. Any thoughts in that sort of space when it comes to, all right, if we're sort of entering a little bit of a rough period in our relationship with our local Pacific neighbors. It's not Pacific. What's the anyway?
Geography is clearly not our thing,
mate. I've had too much to drink.
Oh, geez, it's a big question, isn't it? If we go to war with China, like what you said, Jason, we kind of in some ways already are. We're just in a different type of a war. We're what we'd call a trade war.
Yeah.
And typically when we go through markets, look, here before I go through there, I can tell you what stocks I'd short. I'd short Huawei. I would probably short Tencent, and Alibaba would probably be my top 3 shorts if we went to war with China. There'd be a few others, but just given that I haven't had more than 30 seconds to think about it, geez, there'd be a lot. As a matter of fact, I'd get on the blower to Michael. You're probably watching, Michael. I'd get on the blower to you and figure out what the hell's going on, because he was one of my mates who's ex-IB hedge fund manager, now lives. I think he's still down here. Haven't seen him because we've been locked up. But when everyone was, getting out of Hong Kong and shorting and blah blah blah, he's like, no, buy, double down, and it was the right decision. But geez, you had to have a nerve of steel while it was plummeting, I can tell you. We kind of already are in what we call a trade war. So typically, what happens before we get to wars is we end up with a currency war. And a currency war is when different nations try and get political advantage by manipulating the value of their currency relative to each other. Right. And so we can do that in Australia by lowering interest rates. If we lower interest rates, then generally our dollar will decrease in value relative to other places. There's other things that we can do.
Yeah,
that's one of them. China can synthetically just manipulate its rate wherever it wants to go. And they've done that a few times to combat the trade wars and the sanctions that were getting put on China from America. I remember Mr. Trump, the little or the big Oompa Loompa, the orange face and the weird hair. Well, actually, my hair's not too great at the moment, so I'm not going to throw stones in a glass house. But so the trade wars come next, and typically, and we have to go back a long time, but typically what ends up happening is the restraint of trade between countries or one country or a group of countries and the rest of the world becomes so tense that it becomes explosive and a real war is a result of that. The reality of real wars these days is that we've seen that they tend really not to work, and we've got weapons and things that are big enough to basically wipe a country off the face of the planet and do a lot of damage to the planet at the same time. So I think going to a real war is almost like a bit of a posturing game while other games are taking place, and those games are well afoot at the moment, being trade embargoes with Australia. I mean, they've slapped us with, embargoes on wine, on our meat, on so many different things at the moment. We're still kicking on. And I think, so are we at war? We're not really at war, but we're certainly in various degrees of trade tension. And I think that we're going to see a lot of that continuing to play out.
Yeah, and that's the stuff that'll play out for us, won't they? Really at the end of the day, in the world of the real estate, Harry, that plays straight into your question. If you're still with us, Harry, Harry's asked the question, what are the possible factors that could impact property prices in a negative way? Well, certainly the increasing of interest rates can, if too harsh from a low base, folks, can be significantly negative when it comes to property prices, especially as Andy alluded to earlier tonight, that if wages do not increase, then it is very difficult to see how increasing an interest rate could not have anything but a negative effect on property prices and or put stress on people and mortgages. All right. So I'm a firm believer right now. I think many of the governments around the world have snookered themselves when it comes to interest rates. Andy and I have talked about, as soon as we're allowed out of lockdown and travel, and hopefully we can fly again and whatever in the next few years, we're going to do a little bit of jaunting around and go and visit a few places that have been at low or no interest rates for, sometimes even decades, find out a few things. Go to Japan as one of the early ones on the destination. But if somehow, Harry, interest rates went from, 3% for homeowners to 5 or 6%, just imagine doubling interest rates for people with no wage growth or low wage growth in a period of time. That could affect property prices significantly. And right now, property prices going up 20 or 30% in a short period of time. There is a very immediate correlation between the cost of the funding going down 20, 30, 40, 50%, Andy and Harry. And that's reality. If the interest rates were still 6% or 5%, we wouldn't see growth like this right now, no matter what was going on with our supply chain. We would have some, tightening, but we wouldn't be seeing growth like this. The other one, Harry, in the short term, that will have a negative impact on property prices is the property prices themselves, Harry. They are, I believe, starting to find a place. I think 12 to 18-month run now that it will level itself out, and you'll see a sort of an 18-month to 3-year run on property prices. What will happen, Harry, in certain places, depending on where you are, folks, investors, sadly, are the good time Charlies of the property market. The good time Charlies. And Andy, I was telling a bit of a story about this not so long ago, about 10, 15 minutes ago. Didn't get to finish that. I was chatting with a client that they're, 4 years into a property journey, and, they're sad that everyone else is reportedly property prices gone up 150 grand and theirs hasn't.
The great property fishing story.
Yeah, it's a bunch of bullshit. Not every property price has gone up, team, gang. Like, it's just a lie. The marketplaces are moving in a positive direction. Matter of fact, property prices in certain places are being led top down. Luxury end of town is actually growing a little bit better in this cycle. That will flow. It will benefit across the market. But, at the end of the day, not every property rises in every market cycle. That's like not every share price goes up in every ASX. The ASX went up 20%, and why didn't my shares in ABC company go up 20%? Well, because that's not how it works, folks. And Harry, your question, is one of the things that we saw. I've seen this twice now in 2 property cycles. Ill-informed, uneducated property purchasers buying at the top of the market, and then not seeing capital growth, like 1 minute later, selling properties for a loss, will have a negative impact on property prices. Not long term, but it usually plays out in a pretty average way, depending on where you are. So there are probably 2 or 3 things, Harry, that will have an effect if they come to play, as we roll down this highway called, I don't know, the future, Andy. I don't know. That's anything from your neck of the woods, mate.
But I've got a couple of extras for you, again, because it's cynical Andy that's a bit feisty tonight.
Feisty Andy, call it feisty. It's better.
And I'll say that that stupid policy, will stupid policy.
I'm glad you're here. Yeah,
will potentially crush various different parts. It'll be short term because policy tends to have that ridiculous effect. But I think that one of the biggest risks to investing in general, and I talk about it with all of my clients all the time, is the government. The government is one of the number one risks to investing in general because they have the largest impact. They have all care and no responsibility, or maybe it's meant to be the opposite way around. But quite often they'll come in and they will decimate markets over very short periods of time. And the reality is there's very little you can do about it. And the best advice you can have there is don't sell, because it will generally, the market will find its way back out. Depending on where you're at, obviously. If you're in a dog stock or dog property, then you probably shouldn't have bought it to begin with. But
dead right, folks. We've got a saying around here, property people. Chuck it in the chat for me, Andy. Chuck it in the chat, team. There's a saying. We say it positive.
I can start it, mate, when you give me the get-go. I think I've heard it long enough now that it's actually become part of my morning mantra.
I love it.
So for those of you who don't know, it's buy well.
It's coming. I'm sure it is. There it is. Even Harry's on it. Harry's all over it. Buy well, never sell. That's it, baby. It's a marathon, not a sprint. Yep, absolutely.
Fantastic. You've even got the acronym up there, BWNS.
Oh, Michelle. Boom. I love that. I've got a little acronym going on now. All right.
Not to be mixed up with BWS, which I think is a bottle shop. But,
well, if you're watching Wine and Wisdom, Andy, it could be mixed up very easily in that way, couldn't it?
But one of the other parts, and this will be an interesting one, Jace, because I think we're seeing parts of this out here. You will know better than I. My understanding is that from release of land to realization of property, about a 7 to 10 year cycle.
Yep. Certainly big greenfield stuff. It takes a decade to get it up and out. Yep.
So what could potentially hurt some property prices in a decade from now? And let's face it, if you're an investor, that's really what you should be looking at. You should be looking at longer term trends and going, okay, well, we're on this one. What's the next trend going to be? And what is the right place to be for that next trend? But if they decided to go bananas and start to do what politicians with short time in office tend to do, is they make gregarious changes. And so if they released a ridiculous amount of land in Victoria up for development, I would venture to say that in 10 years' time, we could, if that was well and truly disproportionate to what potential property population increase, so on and so forth, it could have a very, very negative impact on a certain variety of property.
Yep, certainly. Yeah, that greenfield. So greenfield, folks, is paddocks that need to be redeveloped, like on the fringes of cities. And the other place, Andy, that can happen. So on the fringes of city, folks, 5,000 new home lots just flood the market. Or the other place, Andy, that happens often is CBD locations, the 000 locations, where they can, without fanfare, because those places are very easy to change the zoning laws.
Mm. Oh, we saw
You
it in
could,
Melbourne, didn't we? Jeepers creepers.
actually, Melbourne. Unfortunately, Melbourne had the worst reputation in the world. They built the worst. They had the worst planning instrument. They did from 2000. I think it was 2006 to about 2013. There was almost a whole decade of the worst apartment approvals and building, like in the world. The one bedrooms with no car parking and no windows, and they were just they were hideous. So,
Yep.
but so those are the two places that can easily, without too much fanfare, be redeveloped and rezoned for mass supply. And thankfully, we talk a lot about flight to quality and infill locations. And my preference is to purchase as an investor in better locations rather than for pricing. But we don't have time to dive into that one.
It's one of the big problems, though, isn't it, Jason? Maybe this is where we put a pin in it and chat about it maybe next week, is that, it's this, what I'm starting to realize the more that you and I talk, and what I'm starting to learn, is that there really isn't that much difference between property and stocks. Like they're very similar. There's just a different transactional rate to them.
Yep.
But one of the things that tends to happen in both, and arguably equally, it happens, is that that sort of exuberant buyer that sort of come into shitty stock or not good stock. Like if you've got A-rated, and we're not talking about GFC stuff where the A-rated was really D-rated, but or X-rated, should we say? But if you're in sort of A grade, not everyone can afford to get AAA rated stock, right?
Yep.
And not everyone can afford to get the A rated stock. But there's a big difference between B plus and B minus and C rated stock.
Yeah. Yeah.
And the kind of volatility in those markets, where when the whole market is moving up and everyone's a stock expert because they bought Afterpay, and everyone's a property expert because they bought in at the right time, is that then the big danger is when people just buy from lack of knowledge and just desire to get in, and don't actually spend a bit of time starting to understand it, and they're the victims that then get basically sold a dud by the, as you'd probably say, the good time Charlies of the world, who are probably businesses that were born yesterday, will probably be gone tomorrow or a few days after tomorrow.
Yep.
And that's what I think people really need to watch out for, because if you can stay above that line, you'll always be okay. It's just a matter of time, and if you've got the ability to hold.
Mate, they're right, mate. It's the FOMO. It's the FOMO and the good time Charlies that cause all sorts of problems when it comes to, those things in and out, that transactional stuff. But mate, I think you said, like you said, I think that's a good time to put a bit of a pin in it, my friend. Good to hang out with you. there's plenty more. I reckon we could chat for another hour. But I don't know if anyone wants to hang out and chat for another hour. But great to have all of you guys on again. Yeah, Michelle, we don't want any tin pot turkeys. Passing any commentary, that's for sure. And fantastic to have you guys hanging out. Andy, mate, good to hang out with you again. Another
see you, bro.
Cheeky wine on a Friday. As always, folks, you guys stay safe wherever you are. Keep give us a shout out if you need anything. We're here to support our communities and our industries. And hopefully, wherever you are, you're keeping yourself entertained. If you're in lockdown, sorry for rubbing the salt in the wound about the haircut, but you know, keep your chin up. Keep your chin up. I reckon we're on the home stretch for that thing anyway, and then we'll be into a different version anyway. So,
mate, I've got a new saying, and it's you heard it here first because this is the first time I'm going to say it. So I'm probably going to butcher it. It's last in lockdown, first to travel. There we'll go.
There you go. All right.
Last in lockdown, first to travel. So we'll see whether that one comes true. And maybe that's something that we can look forward to because the haircut is still a little bit out of the way for us. But maybe travel might be a little bit closer for us. So maybe we can look at the silver lining.
You never know. You never know. Well, folks, it's a good night from me.
And it's good night from him. Good
night.